It is Friday, January 15, 2021. This is the Real Vision Daily Briefing. I'm Ed Harrison, and I'm going to be joined shortly by Real Vision CEO Raoul Pal. But first, with the news of the day, Jack Farley.
Thanks, Ed. Price action was risk off today. Bonds rallied as U.S. equities edged lower alongside copper and oil. Energy was the S&P 500 sector that dipped the most, and interestingly, ExxonMobil was down less than some of its peers, despite the investigation that the SEC launched probing whether the company overvalued key assets in the Permian Basin. A flight to quality, perhaps? The banks had a rough day as they reported earnings. JP Morgan reported a record quarterly profit of $12.1 billion for Q4 2020. It achieved this not just by its strong investment banking profits, but also by decreasing its loan loss reserve, which it booked as a profit. The bank also reported that deposits were up 30% year over year, largely due to the Federal Reserve's balance sheet expansion, or QE. Despite this, JP Morgan was down on the day. The riskier banks, whose balance sheets are less of a fortress perhaps, did not fare so well. Why this roadblock in the reflation rotation? Well, you never know. Was it the US Census Bureau announcing today that retail sales were down for the third consecutive month, well below expectations? Or was it Biden's stimulus plan clocking in at $1.9 trillion that didn't quite deliver the shock and awe that markets were hoping for? In other news, even though credit risk is priced at record lows, interest rate risk looms large for the bondholder. Despite spreads continuing to decrease, U.S. investment-grade bonds actually had a very bad time last week, which in terms of total return was the worst week since August. This is because bonds are now more sensitive to rising interest rates than ever. In other news, the epic short squeeze on GameStop appears to be over for now. What happened was that traders on Wall Street bets conspired to drain all dealer supply of the stock, triggering on Wednesday the margin call of all margin calls, which led to the stock skyrocketing over 100%. Lastly, the CDC reported today that they predict that by March, the B117 variant of COVID-19, the much more transmissible one and the one that first appeared in the UK, will likely be the dominant strain in the US by March. That's all from me. Back to Ed and Raoul.
Thanks, Jack. Raoul, it is Friday. I'm excited. It's great to talk to
you. Two of us, the dream team, back together, Ed.
Yeah, let's go. And I was telling you that before this, I had a daydream that we were doing this, and I ripped open my I wear these what do you call it? These sweaters, and it had a Gas Monkey T-shirt on, just like you wear. And I didn't tell you the second thing that was in this dream was that I had a background that was exactly like yours. It was like a fake background, and it had a pool ball. It was only the cue ball that was on the pool table. Okay, just like you have right now. So it's like, what does that even mean? The pool ball, the cue ball there.
I don't know. Everyone says, "Well, why aren't you playing pool?" I'm like, this isn't a bar. This is my house. And if I'm actually on television, I can't be playing pool at the same time. Well, I could be. I mean, I could get up and play pool if you wanted, but I'm not very good. But I'll give it a go.
So they're gonna critique your form, that. Oh, that's not bad,
And I didn't get anything down.
Hey, so for all of you watching this, please, in the comments, critique that form. What is Raoul missing? How well did he do?
I'm missing an ability to play pool. 2, any coordination whatsoever. 3, a drink.
So, Raoul, it's a raucous Friday, bad market day in some ways, but I'm not even going to preface it in terms of what I'm thinking. What are you thinking? What's on your mind about the markets right now?
I raised it last week, and I've been raising it for a while, and I've been raising it on Macro Insiders, and you and I even talked about it last time we were together, is we're in a risky window now. The window is Europe shut down. We've just seen, I think, Toronto get shut down, peak virus, a slowdown, Biden about to come in, the probability of more restrictions across the US rising. We've also just got through all of this option gamma that's rolled off because it's option expiry, and that was keeping the market up. So it's kind of, we're now at that period where things can change. We also talked about Okay, the dollar was massively oversold. So, and it had the largest speculative positions short the dollar in history. So that's starting to get unwound. We've seen, the equity market, which is a huge speculative excess right now, for whatever reasons people want to talk about. And all of this stuff starting to feel like it's going to come unwound. And it's something we've all been expecting, and it's not something I've been trading. I've been long the bond market, which we'll come on to in a bit as well. And even crypto is getting shaken out today in a very, very volatile Friday. I'm not sure that this is not a sign of a larger corrective move. Retail sales today as well, pretty terrible numbers.
Yeah, I must say that, I mean, what you're talking about, it sounds like, there is a lot of froth that needs to be taken out. Just from a macro perspective, the question the period that we're entering is, how frothy is this? And I think Jeremy Grantham, what he put forward, I don't know if you saw that piece. It was very compelling, I had to say. The thing about it, just from an equities perspective, that I found most worrisome, however, was his comparison to 1999 and 1929. That we're in the midst of something that's epic.
Yeah, I mean, look, I know it's unfashionable to be a macro bear, but when you see $1 trillion of penny stocks trading in a month, that's never happened in history, nothing close. It tells you the speculative excess. We've seen individual option trades, all-time record highs. Pretty much every measure has shown speculative excess that hasn't been around since 2000 or 99. So you got to take it seriously. I mean, does it mean that we're about to have a massive bear market? No. Could it? For sure. I mean, this is not a market for widows and orphans. I think you just have to be careful.
Yeah. Talk to me about that in the context of the dollar, this massive dollar short that you were talking about coming unwound. I mean, it seemed to coincide with a relatively aggressive move up in terms of the steepening of the yield curve. What's leading what? And is that something that is a persistent move? Or, as you say, are you on the other side of that?
Yeah, it's complicated. I think Roger Hurst laid out a good case that the entire reflation trade is mainly a dollar weakness trade. And if you look at the correlations, it seems that it's the most likely cause. So as the dollar reverses, it unwinds a lot of the reinflation trade. But rates did back up, and I found that unusual. Julian and I on Macro Insiders had talked about it at length. I mean, he's a reflationist, and he thinks that the reflation story means the bond yields go up, and then the Fed maybe have to intervene and implement yield curve control, and it causes an upset to the equity market. That could be the case. Or it could be the case that bond yields are out of step with what else is happening. If you look at bond yields around the world, if you look at real-time economic data in the US, it's all fallen. And we've seen it with retail sales. I was warning people that December was going to be terrible. I called it the Grinch that killed Christmas. And that's really what happened, that Christmas spending season disappeared. So maybe bonds are at the wrong price. And that's a bet I quite like, because you can buy bond call options, TLT call options, or options on futures relatively inexpensively. If my bet's wrong and I'm the idiot, I don't lose a lot of money. If I get it right, I can make a ton of money. And they're very much at the top of the range, something I've been tweeting about. And I know Travis as well, who took his first daily briefing yesterday in disguise.
Yeah, I thought it was good. It was good. He brought the heat on certain issues. One's on crypto that I didn't know anything about, to be honest.
Yeah, and it's encouraging to see hobbits on television nowadays, not just in films. But no, he did a great job, and he's been very bullish on the bond market as well. So, we actually both differ massively on Bitcoin, but on the bond market, it feels like a decent bet. I'm not an inflationist. I've said it repeatedly. I'm still thinking every recession I've ever seen, the deflationary or disinflationary hangover tends to last 2 years. and usually the central bank are still cutting rates, or governments are still stimulating at least 18 months after the recession's gone. Why would this be any different?
Yeah, especially with the excess capacity, right?
I mean, I don't get it. Right, the Fed keeps saying unemployment at the lower tier, i.e., the least privileged in society, if they don't have a job, that's who we're concentrating on. Yet the bond market thinks, no, they don't mean it at all. Look at the price of copper going up. It must be inflation. I don't buy that. I think that if you would go and ask the regular person on the regular high street anywhere in the world, they are in a world of pain right now. Any ordinary business. Elon Musk is not an ordinary business. Amazon is not an ordinary business. But the ordinary restaurant, the ordinary bar, the ordinary hairdressers, these people are in a world of pain right now. And that's deflationary. I think the marginal propensity for people to save money is much higher than people expect.
Yeah, I would agree with that. I had a conversation with Lakshman Akuthan today, where he was saying things that were very much the opposite of that.
I can never pronounce Lakshman's surname.
Yeah, I think that the last part, the thin part, he coached me on. So if I'm saying it wrong, he can tell me I coached you wrong, or like, Ed, you have no idea what you're doing. But yeah, I think I got it right. But he was saying totally different stuff. I came at him with all the usual stuff in a very respectful way, but he put a cogent thesis together where I would say what he's saying is that the super tanker is very difficult to move, and the these leading indicators are telling me that if you're moving the super tanker, it's not moving from a generally favorable trajectory for the global economy or the U.S. economy. I mean, the takeaway for me from that is not necessarily that there won't be very large decelerations in that would cause the yield curve to flatten in that period of time, but it doesn't necessarily mean that we're going to go back into a March 2020 situation. I'm still trying to put my head around the whole concept.
Europe, we're seeing a double dip. Of course, it's not going to go back to the lows of March, but we're seeing a significant double dip. The UK, we've seen a double dip, and in several other countries, we've seen a double dip, and the US real-time economic data is starting to show similar. So I do think the yield curve, in the terminology you're using, flattens for a bit. It would make sense to me. And then after that, I think the full recovery comes through in due course. But, it's not clear. Even Biden's new announced another 2 trillion. I've lost count of the trillions now, but this would be like trillion number 5 if he gets this done. It's still not clear how, when you give transfer payments to people, how inflationary that is when people have this propensity to save. So I'm just not sure that this is the big event yet.
Right. The reflation nexus, the narrative of reflation, the point where I have the biggest problems are around the currency and rates, because basically if reflation's in play, rates are up as they were recently, and on some level the dollar is up if rates are up. There's a natural tension there, to the degree that the rates being up is the last part of the reflation trade to actually make its currency. If it happens enough, it has a reflexive sort of action with the dollar, and that basically unwinds the rest of the reflation trades, because as soon as the dollar goes up, all the other things start to look horrible from a reflationary perspective. The DCF for equities doesn't look as good. Commodities don't look as good. None of those other reflationary trends happen. It seems to me that there's a very limited range within which this whole nexus operates, and we're starting to get outside of that range.
Yeah, I think so. I mean, the other thing that's interesting, I'm just looking at my Bloomberg screen now, is 10-year rates in the US, 1.1% roughly. 10-year rates in Germany, negative 53. 10-year rates in the UK, 5 basis points. 10-year rates in, the UK is, 28 basis points. Then we're looking across the world, they're either negative or zero. And the US rate, I still think, are still far too high considering what's going on. And I think it's just going to attract capital.
Yeah, I agree with that 100%. Let's focus on the UK for a second, because I think that they're the easiest ones to look at. Let's say the US, and the UK, these are fiat currency issuers. They have the largest degree of freedom because, it's not like in Europe where you have those problems. They're running deficits like crazy. They're running current account deficits as well. Yet, you just gave me a number, 28 basis points. That's like 80 basis points lower than where the US is. How is that even possible? And what's more, I would even say if you look at the UK 1-year rate, it's minus 13.7 basis points. What's going on in the UK that's not happening in the US?
Well, obviously the markets interpreted the narrative would be the markets interpreted the second round of COVID and the full lockdown of the UK as negative. The reality is the UK curve went negative a while ago. It's been negative most of this year as soon as this hit. The US hasn't. There is an inherent belief in investors that the US cannot go negative. It's the world reserve currency. How can the US rates go negative? And something you and I have talked about many times is that it's not up to the central bank. It's up to the market. And at some point, and I'm looking at the 2-year rates now, there's a beautiful flat line at about 10 basis points.
Right.
Right. We're currently at 13.5 basis points. So 3.5 basis points lower, 4 basis points lower, we've broken the support line. Next stop, 0, and probably negative. So, okay, so what is the probability of that? We go back to this COVID slowdown. If this continues, and let's say the equity market sells off a bit and the reflation trade comes off, all rates are going to 0. And then people will start flattening the curve because they'll go out the curve. Now, what's really interesting is, if you remember, we were talking about how short everybody was the dollar. Mm-hmm. Well, they're even short of the bond market. Record shorts in 30-year bonds. They've just turned short net negative on 10-year bonds. The market doesn't believe that this could possibly not be reflation. And if they're wrong, there's a bloodbath to come from the shorts in the bond market.
Right. And, interestingly, in all of that, what you were saying is the markets are telling you what's going to happen. To me, this negative rate stuff, which predates the B117 variant in the UK, it's basically the market saying that, oh, by the way, the UK central bank is going negative. This is what's going to, it sounds to me, and we've talked about this before, like when you have minus 13.7% on the UK 1 year, the market is forcing the Bank of England into negative interest rate policy.
Yes, and what it's telling you, and they will tell you, when Euribor went negative, it took 18 months before the ECB did. The Bank of England will probably go negative, call it in the next 3 months. But that's given them about 9 months to figure out, is this going to break our system? Are the banks ready for it? Can we do it? So, I mean, that's a normal path, and the US will go through the same. There'll be the fear, is something going to break? No, it's okay. And then that happens. So, it takes time to play out and come through. But I honestly, and I've said this for a very long time, I don't think this cycle's over until rates go negative everywhere.
Yeah, and I would agree. And, the caveat, and this is something we've talked about before, Bill Campbell, who works with Jeffrey Gundlach at DoubleOn, what he was saying is the last hurrah in terms of flattening or going to 0 and beyond is that crossing the Rubicon into negativity, because as soon as the Germans went in negative, it just went straight down, to minus 1%. They hovered at minus 80 basis points. But so, there's still another 70 basis points, 80 basis points for the UK, more to go. And if the UK is going, it sounds to me like you're saying the US is going that direction as well.
Yes, because almost every other major nation in the world is there. So, I think Australia hit negative rates. I mean, they're at 9 basis points now, but they hit zero at least. New Zealand got negative. I mean, what's left? So if you are one of the world's large sources of capital, let's say sovereign wealth fund in the Middle East, and you want fixed income, what are you going to buy? Bonds or treasuries? Chances are you'll go for treasuries, particularly if you think the dollar's probably oversold. And that just in itself collapses the spread between the nations.
And that definitely tells you about the Eurodollar situation. For me, that's the question I have for you on that, because obviously, if there's that huge spread, there's going to be some plays in the Eurodollar market.
Yeah, look, the Eurodollar market is a fragile beast. Many of us have spoken about it. Funding is there until it's not there. With negative rates, it seems to slow down the velocity of money everywhere. Now, the US still has the highest velocity of money, and maybe that's the reason why the yield curve is a bit steeper and the bond market's higher. The velocity of money in most major countries around the world is now below 1. The US is still just above 1, about 1.25. So maybe that just explains the difference. Because the US banking system seems to work a bit better than the European or the Japanese banking system. But the Eurodollar market itself, if we start to see a scramble for funding and we see rates goes down, then we'll see the Eurodollar market break 100, which is saying that rates across the board are going below zero, which again was, Euribor is the similar version to Eurodollars for euros. That went negative well before the central bank did. So people have got to keep their eye on this stuff because it's not very good for the banking system either, as we know. The banks have rallied a lot because they're very positive because the yield curve steepened. But let's wait and see, because if rates go lower again, banks' margins get crushed and banking stocks act like utilities at best.
Right. And, what do you make of JPM's earnings? Because the thing that stood out for me, they reported 12 billion, which was a record, but they took their loan loss reserves back. They basically said, you know what, we overestimated how many losses we're going to have because the Fed bailed us out. Fiscal policy bailed us out. Is that something for us to? I mean, because the market's basically saying, okay, this is why we're in the reflation trade. JPM just told you that our trade is good money.
Yes, and maybe it's good money for JP Morgan and the banks because, right, as they correctly said, you provision for the losses. The governments did the right thing and created the fiscal buffer. It protected the banking system. Good job, central bank. Good job, governments. I mean, that's their job. That's encouraging, but that doesn't say reflation. That just says we were protected by the government. Thank you.
Right. And it's also JP Morgan. It's not Citibank. It's not Deutsche Bank. In that succession, I would say, by the way.
Exactly. JP Morgan are a pretty smart bunch. They know what they're doing. And, good for them that they're over provisioned. I mean, that's great. But, the banks I was worried about earlier on in the year, they've rebounded. What's interesting is their reserves and stuff are all related to the value of their equity as well. As the equity goes to zero, they have to reserve more. So it's freed up balance sheets. So it's helped them somewhat. If the market turns lower again, it actually restricts them again. And that's just the way that the kind of banking regulations work these days. So we have to always keep our eye on them, because if share prices fall, they become less able to lend.
Right. Now, two things that we haven't talked about that you probably don't want to talk about because it's not the markets, but I'm going to introduce anyway. I want to get in there. Number one, let's actually talk about the easier part of the two, B117. And actually, there's another mutation apparently, or one or two others, in South Africa and other places. I mean, do you really think that, do you care? That's the question. Is this a imminent threat? The Ontario government, as an example, has said basically we're locking down because we know that B117, the curve looks like this with B117, and it looks like this without it. we this is like for us, March 2020 again.
You've seen it in the UK very clearly. The US, again, they're warning about it, but nobody wants to listen. So the probability is rising of an exponential growth curve to come again in the US. But everyone's like, la, 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 I can't hear you, everything's going to be fine. That's okay, if that's what, but I think the probability is otherwise. Let's see, let's hope the US avoids the situation, because again, if Biden fought the election on this, he's going to have to be as strong as possible as soon as he comes in, because he can't go, well, don't worry, guys, just do what you want, just go to bars and restaurants. He can't allow that. If he fought the election, say, we would be tough on this and we're going to give you guidance on how to deal with it. So people have got to expect that. The market hasn't got its head around the fact that there will be a government-induced slowdown of the economy, most likely.
And how much of what you were saying previously is related to that incremental negative impact on the economy, and how much of it is related to, okay, this is just just going forward, not even thinking about B117. These are the facts.
They're all related, right? Because this whole recession is basically driven by the pandemic.
Right.
So if the pandemic rises, the balance of probabilities are that the economy falls. If the pandemic falls, the probability is the economy rises, right? It's not rocket science. So if we are seeing a large increase in the virus, forget governments. Let's assume there is no government. We live in libertarian paradise and everyone's free to do whatever they want. People will still stay at home and stop spending.
Right.
I mean, obviously, my mother's in lockdown in Spain, but she's not going out because she's 77 years old, and the last thing she wants to do is become seriously ill. So it's, even if humans overestimate their probability of mortality, which they do, that's why we survive. We have a survival instinct. We always overestimate our the chance of death. But because of that, we take evasive action. So I don't see any other outcome but economic slowness. It just makes sense to me without knowing what we know about the virus.
I wish I could disagree with you, honestly, because there's nothing you're saying that doesn't make any sense. Let me spin the high probability tale for you that I see. I see exactly what you're saying, and I see people saying, "Wait a minute, okay, from a reflation trade perspective, the problem with all of that is the bond market. We're going to flatten the yield curve. We're going to stick to everything else." But the first thing to go is the yield curve. That's going to reflatten for us. And then when that reflattening happens, we'll be back to where we were when it was the FANG, when it was the stay-at-home stocks that were working, et cetera. But to me, we're going to be in a new situation because multiples are much higher now than they were 6 months ago, 7 months ago. And the runway for the virus will now be further than people thought. So there's more fragility in that situation than there was, say, in June when we were in the reopening.
I agree. The problem is in this equation is most people tend to look at the stock market. That's their view of the economy. But you and I know the stock market's a pretty bad macro variable. The bond market's an exceptionally good macro variable over time. The currency market, somewhere in the middle, commodity market, somewhere in the middle, and the equity market's awful. It's like 80% noise and 20% macro. So I think, I don't know what happens to the stock market is the honest truth.
Right.
Does it go to a new ridiculous, even more super duper ridiculous level? Maybe. Does it fall 30%? Maybe. I can't get an edge. I don't like it. I actually bought some puts for Global Macro Investor because I feared what's going on now. And, I did that a couple of weeks ago, but I actually don't have much of an edge in that. But the bond market, I tend to be quite good at that because it actually follows the economy. And so, I err with your view that the bond market is probably what we need to be looking at always because it tells the economic truth.
Yeah, agreed. So here's where the uncomfortable bit comes. This is the political side. It could be completely comfortable because you're just going to say, I don't care. Um, we had the whole storming the Capitol thing, and so we talked about it. And my initial view certainly was that it had some significance. But let's be honest, at the end of the day, politics don't drive the economy. The economy drives politics. The economy and earnings, all of that nexus is what's driving the politics as opposed to the reverse. Is this a different scenario here? Are we seeing something fundamental occur that's going to have some sort of feedback mechanism into markets and into the economy?
Again, the answer is I don't know. I mean, I really don't. I mean, I haven't lived through this before. I've lived through the decline of industrial Britain in the late 70s. There was a lot of rioting. It was miserable, but they didn't storm the parliament. But we've had protests at parliament, obviously, in the past in the UK. I don't know the magnitude of this. And I think just the fact that the transition of power is happening next week is a good thing, because there's a chance then to, in Biden's terminology, heal some wounds. Whether it heals, who knows? What was the answer for social media? I don't know. It's between a rock and a hard place. What does it do? Allow it all, or ban it? Well, both seem right and both seem wrong. And so I don't think there's a black and white. People say, well, anybody should be allowed to say anything. Well, you can't if it leads to people causing violence at the Capitol. Sure, they should protest all they want, and that's their right. But to incite violence, take weaponry, okay, that's a different thing. Governments generally tend not to like being overthrown by violence. Tend not to well. Now, obviously, there's a few revolutions. Are we at the point of revolution? I don't think so. And
I'm going to knock on wood as you say that.
And I don't really think, what do I know? I've never lived through this. I have no idea. The only thing I can say is, as an outsider watching the US, it's a terrifying shit show. And just to see it rile up people even more is sad. It doesn't stop. This polarization of it's them. It doesn't stop. And people have to realize that they make their own lives unhappy by endlessly blaming others, whichever side anybody's on in this equation. And that the best way of dealing with this is figuring out what are the real problems at core and trying to find pragmatic ways of solving them work for everyone.
And before storming the Capitol, how much worse or better was this than Brexit, as an example? You're someone who has their pulse on the UK also, because you're a UK citizen.
Listen, I've lived. There's some periods of civil unrest. I was in Spain during the 2012 EU crisis, and there was a lot of people out in the streets, huge millions in the streets, rioting, anti-police, all of that. So I've seen that. The UK was almost as vicious politically, where you lost touch with friends over it. The US just went one step further.
Right.
UK in the end settled down. Everyone's like, I get it. We need to find an answer. It's happened. But the US has done the opposite for the time being. And let's see whether a new administration, whether there can be some middle ground. I don't know what the second impeachment is. Is it just theater? Again, I just don't know. I don't know what the next act of Trump or his kids are. Maybe he's not allowed to take office again, but his son might be. And again, some people will think that's a great thing, and other people think it's a terrible thing. I don't know.
When you say you don't know, the obvious thing that comes.
Sorry, Ed. I think the key point is one of the terrible things about this is I can't state my opinion because we're in a public media channel that doesn't have view, and I have a very strong view about this. I can't talk about it.
Right,
because for fear of backlash. for expressing opinion. I can argue with me about the bond market. It's not a problem. But if I were to say what my view is, it becomes news, and that's how bad the situation is. We're actually not allowed to express an opinion.
Well, I think that's the right call. What I would concentrate on, what that you said that makes sense to me is when you said I don't know, because ultimately for me, from a market's perspective, that's the most important thing, and it makes me think of Knightian uncertainty. You know, this guy Frank Knight, he talked about Knightian uncertainty being a lack of any quantifiable knowledge about an occurrence, as opposed to this quantifiable risk. There's this range of risks of outcomes that we can plot on a scale. This is a situation when I asked you at the beginning, what's going to happen? You're like, I have no idea what's going to happen. To me, that's a situation from a market perspective that you can't hedge. Okay. So it's either this is going to happen or it's not going to happen. And to the degree that one or the other happens, that could be for people who are positioned one way or another a risk, a macro risk of great significance.
Yeah, problem is I can't quantify the risk and I can't quantify the outcomes. I'm not saying there are no risks and there are no outcomes. I just have no idea. And that, to me, as you say, tells you there's a potential that people get tipped out of their positions. If people know there are risks and can't quantify them, what is the answer? Reduce your risk.
Right. Yes.
And if everybody's on one side of the boat, everyone starts moving back to the other side of the boat.
Yeah. So let's end this then talking about, I think we already know what the answer is. I spoke to Lakshman. I was talking to him about the death of macro, right? Everything that we just led up to me, speaks to the whole, that whole discussion of the death of macro is total bullshit. When I say it's total bullshit, are you down with with that? And what's your view?
So I'm just going to pick up my January GMI now, and the second topic number 7, page 59. The macro king is dead. Long live the king. I think that there is a risk that G7 macro is dead in terms of the structural shifts. Right, my career has been bond yields falling. That's been a huge trend. The equity market rising. Been a huge trend in my career. I worry that if we look at Japan, dollar yen traded sideways in a kind of noisy range, but pinned around 105 for 2 decades. What happens if the dollar did that? And if bond yields were pinned at 0, and therefore credit was pinned at about a few basis points, and the Fed didn't ever let the credit market implode because it implodes the pension system. Okay, so there we've got all of the key macro variables, currency and rates, not operating. So where does that leave the stock market? I really don't know in that environment. Where does it leave investment opportunities? Well, the same as in Japan, the same as in Europe, the same as in the UK, the same as in Canada, the same as in Australia, the same as in New Zealand. Okay, if FX doesn't go anywhere, then capital has to find somewhere to go. And that's the death of macro in the G7 world or the G10 world that we all grew up in. It's probably very bullish for emerging markets because capital will find a return. And in that environment, there's no return in G10, but there's return in many other places. If we go into a different world, as if by magic, and we're now in India trading macro, I look at my screen, Indian rates are at 6%. Indian 2 years, 4.5%. Okay, well, that's a different world to start with. Guess what? The population is 32 years old. Okay, well, that's very different. So there is an alternative universe that doesn't look anything like this. But investors are so used to this US G10 bias. It's going to take a while for them to get used to it. So that's my death of macro, is that the opportunities that come out of macro trading tend to be more cyclical as opposed to secular, and the secular trend shift goes elsewhere.
I like it. And, I would call it the stroke of macro, where I have a stroke. I can't move my arm. My arm is the one I use for writing. That's the G7 arm. It's dead. It's immobile, but, macro lives on.
Yeah, macro will fight another day. The king is dead. Long live the king. It's just going to look different. The crypto world is another macro expression of risk reward that is new to everybody, and that will only grow as well. So many people who are trained with the skill sets of the old world are going to have to learn new skill sets, emerging markets, frontier markets, and crypto, for example, just new things, and that's great. New opportunity, new sources of alpha, less capital involved right now means that the wall of money shifts over to that.
Excellent. Very great discussion. Yeah, it's great to interview you. We got to do this more often.
Well, yeah, we do. I don't know why we don't, but we should be doing. This should be the Friday special. Next time we'll do it with a glass of wine.
Definitely. Thank you, Raoul. It's been a pleasure.
Always a pleasure. Have a great weekend, Ed, and everybody else.